Here are a couple things that you should know if you're considering an investment in the Robinhood Ventures Fund. Robinhood's own disclosure plainly states an investment in the fund is speculative and involves a high degree of risk with substantial risk of loss. The fund is highly concentrated in technology companies, payment fintech companies, and AI powered companies. Any of these securities may make up to 20% of the fund holdings at purchase. It's likely that the share price will drop significantly compared to the valuation of underlying securities if even one of the companies has negative news or does not perform as expected. Robinhood has said that they plan to hold these stocks through IPO, but it is not given when that will be. Investors could be waiting a while for any of these stocks to IPO. The other thing to be aware of is that RVI has an expense ratio of 2%, meaning you'll be charged 2% of your holdings throughout the year. The fund has waived part of that fee to 1% for the first 6 months of trading. 2% can be considered a high fee, but there are not many options available for the average investor to access these kinds of investments. It does compare better to private investments, which can have a 2 and 20 fee. This means that the private fund manager will charge 2% annual fee and a 20% performance fee. So for example, if the Robinhood fund charged 2 and 20 and had an asset value of 600 million, then appreciated for a 10% gain of 60 million to 660 million, they would charge 2% and 20% on the 60 million gain, which would be $12 million. The good news is that there's no performance fee included in the Robinhood Ventures Fund. I think it is exciting that Robinhood is considering how to provide investment options to the public market. As discussed in this video, there are a lot of positives. It provides late-stage exposure. These are established startups with real revenue, not seed stage bets. It provides liquidity. Unlike traditional private equity, you can buy and sell shares on a public exchange, and it also provides recognizable names. The portfolio reads like a who's who of high-growth private tech companies. These investments are real companies that are generating revenue today. Some of the negatives include valuation uncertainty. Private company valuations don't update daily like public stocks, which can create pricing gaps. There's also the fee drag, where the fund carries the 2% expense ratio. It is currently discounted for the first 6 months. There's also concentration risk. It's a relatively small number of holdings, so a single company setback hits harder to the portfolio. There's also the speculative nature of it. Even well-known private companies can fail to deliver on their valuations at IPO. My take is that RVI is a genuinely interesting product, and it represents a real way for retail investors to access private investments. But interesting and right for your portfolio are two different things.